What if the 2008 crash was stopped? September 15th, 2008, 4:05 in the morning. Lehman Brothers filed for bankruptcy. $639 billion in assets, gone. 2 weeks later, the entire global financial system almost collapsed. Banks stopped lending to each other. The stock market lost half its value. 9 million Americans lost their homes. 8.7 million people lost their jobs. But what if it never happened? Let me take you back to March 2008. Bear Stearns has just collapsed. The Federal Reserve is in crisis mode. Hank Paulson, the Treasury Secretary, is getting 3 hours of sleep a night. And here is the moment the timeline could have changed. On Thursday, March 13th, 2008, Bear Stearns CEO Alan Schwartz calls Paulson. He says, "We're out of cash. We will file for bankruptcy on Monday." Paulson sends him a team to Bear's Madison Avenue headquarters. They spend the weekend going through the books. In our real timeline, Paulson brokered a fire sale to J.P. Morgan Chase for $2 a share. Bear Stearns was sold for pennies. But what if Paulson made a different call? Imagine he decides the federal government will bail out Bear Stearns directly, not a fire sale, a full government rescue. He calls Congress. He argues that letting Bear fail will trigger a domino effect. He asks for emergency authority. Congress hesitates, but memories of the Great Depression loom large. They agree on one condition. Every major bank must agree to federal oversight, new capital requirements, stress test, limits on risky mortgage lending. The CEOs of Goldman Sachs, Morgan Stanley, Citigroup, and Bank of America are furious, but they have no choice. They sign. September 2008 arrives. Lehman Brothers is next. They are over-leveraged. They are holding $40 billion in toxic mortgage assets. But this time the government has a plan. Paulson announces a federal backstop. The Treasury will buy the toxic assets. Lehman will be restructured, not destroyed. The effect is immediate and profound. The stock market drops, but not crashes. The Dow falls 15% instead of 54%. A recession begins, but it is mild. It lasts 8 months, not 3 years. But here's what changes most. Because the government took control of the banks, they could impose conditions. They could force banks to restructure mortgages. They could cap executive bonuses. They could require banks to keep lending. In the real world, millions of families lost their homes. In this world, the number is cut by 70%. But there is a downside, a big one. By rescuing the banks without letting them fail, the government creates moral hazard. The message to Wall Street is clear. You can take huge risk and the government will save you. So the banks keep taking risk. 2012. A new crisis emerges. This time it is the sovereign debt. Greece, Italy, Spain, European banks that were rescued in 2008 took on even more leverage. When the European debt crisis hits, it is twice as big. The United States is also exposed. American banks hold European debt. The second crisis is worse than the first. Because the government already bailed out the banks once, they cannot do it again. Politically or fiscally, this time the banks are allowed to fail. 5 of the biggest American banks collapse in a single week. The federal government seizes them, sells the assets, and wipes out shareholders. The world of 2026 looks very different than the one we know. Banking is a highly regulated utility. The big 5 are gone. Hundreds of smaller community banks have taken their place. Mortgages are boring and safe. Home ownership rates are lower, but foreclosure is almost unknown. The tech industry is also different. Because without the 2008 crash, the Fed never cut interest rates to near zero. There was no zero interest rate policy. And without cheap money, the VC boom of the 2010s never happened. Uber was founded in 2009 without cheap capital. It never scales. Airbnb stays small. The unicorn era never really takes off. Instagram launches in 2010. Without easy VC funding, it struggles to grow. Facebook buys it for $200 million instead of $1 billion. Silicon Valley is half the size it is today. The gig economy never really emerges. Amazon is still huge, but there is no Amazon Prime. No 2-day shipping on everything. The warehouse robot revolution is delayed by a decade. So which timeline is better? In the real world, the 2008 crash was devastating, but it also created the conditions for a decade of innovation. Cheap money fueled AI research, self-driving cars, and the app economy. The fintech revolution was born from the ashes of traditional banking. In this timeline, you have stability. Your grandparents did not lose their home. You were not raised in a recession. But your smartphone is less powerful. Your options are fewer. The economy moves slower. Here is the truth no economist will tell you. Crises are destructive, but they are also catalysts. They force change. They destroy the old guard. They clear the path for the next thing. The 2008 crash was the most painful economic event of the century. It was also the reason your world looks the way it does. So the question is not whether we could have prevented the crash. The question is, what crisis is brewing right now that will shape the next 20 years? And are you prepared for it? What do you think? Was the 2008 crash necessary? Let us know in the comments.